Today we're taking off the rose-colored glasses. No glossy investor presentation, no ESG marketing, and no growth narrative. Just oil, cash flow, and the dividend. And this is Cardinal Energy, a Canadian mid-cap company with around 7 to 8% dividend yield, conventional oil production, and no shale boom story. But is this a stable cash flow stock or just an oil price gambler with a dividend label? And that's what we're going to look at today, as always without the marketing filter. Who is Cardinal Energy? Cardinal Energy is a Canadian oil producer focused on Western Canada. The main regions are Alberta and Saskatchewan. There is no downstream, no refineries, and no chemicals. It's purely an upstream company. The strategy: mature fields, conventional production, moderate decline rate, and predictable cash flow. And this is important. Cardinal is not a shale company. This means we don't see rapid production declines or aggressive drilling sprees, but rather long-lived assets, a high proportion of oil and very little gas. Production is roughly in the range of around 20,000 barrels per day, and that's stable, not extreme growth. Cardinal is a dividend case, not a growth case. Let's also take a look here at how I am invested. I hold a total of 123 shares. My entry price was €4.13, currently with an unrealized gain of 40% and a net dividend of €38.91, which I have already received. The 52-week high and low are between €3 and €6. Currently we are trading at €5.87. Analysts have set a target of €6.10 here, and Investing Pro sets a fair target of €5. I prepare all my fundamental data with Investing Pro. If you also want to use Investing Pro for your fundamental analysis, you can get a 15% discount through my affiliate link, which you can find in the description. Now let's move on to production and the operational base. What is crucial for a company like this? Not imagination, but costs, the break-even line, and of course, the break-even point. Cardinal mainly produces light and medium oil. Production costs are solid, not ultra low like in the Middle East, but competitive for Canada. Important: conventional assets have a lower natural production decline than aggressive shale plays. This means less capex is needed to keep production stable. And that's good for dividends. Break-even? So where is the break-even point? Depending on the source and oil price scenario, the company's break-even is roughly in the range of $45 to $55 WTI. This means that at $70 to $80 per barrel, the machine runs well. Below $60 things get tighter, but we don't have a structural cash burn at moderate oil prices. Now let's look at the numbers. Revenue clearly fluctuates cyclically, and the whole thing is of course driven by oil prices. EBITDA in recent years was solid, but has declined compared to the 2022 boom. Why? 2022 was an exceptional year. The oil price was extremely high. What's important? Cash from operations remains positive, even in 2024 and 2025. Free cash flow fluctuates depending on capex, but there is no structural collapse. And that's crucial. Cardinal finances investments, dividends, and debt reduction from operating cash flow. This isn't wild equity printing, nor is it aggressive leverage. Now let's move on to the balance sheet and its debts, and pay close attention now because this is where it gets important. Debt. Total debt, so that's roughly in the range of 120 to 130 million Canadian dollars. Cash is low, but that's normal for upstream. Net debt is manageable. Net debt to EBITDA is roughly in the range of 1 to 1.5, which is moderate and not dangerous, but also not debt-free. That means we don't have any extreme over-leverage. Important: we don't have any acute refinancing cliffs and no toxic bonds with immediate maturity. And that's solid. But if oil drops significantly below $55, the pressure increases, and that's cyclical, not a structural problem. Now let's move on to the dividend and our core argument. Cardinal currently pays a monthly dividend. The yield is currently at a high level at around 7 to 8% dividend yield, and that's attractive. But is the dividend safe? The dividend is paid out of free cash flow and not from debt. Historically, it has been adjusted, so it's not an aristocrat but rather a cyclical high-yield stock. With a strong oil price, it's well covered. With a weak oil price, a cut is possible, and that's just something you need to be aware of. This is not a forever stable dividend stock. This is an oil cash flow play. Here too, my target buyback zone would be between 30 and 50 WTI in this case, where I would buy more and where Cardinal Energy could also come under pressure. Reserves and lifespans, and now it gets interesting. Cardinal mainly owns conventional long-life oil assets. Reserves last for many years and there is no short-term depletion. And that's important because lifespan means predictability, not a 3-year and the field is empty scenario. Many assets will continue operating well into the 2030s. CapEx is mostly for maintenance, optimization, and water flood programs. There is no extreme exploration risk, and that reduces operational surprises. Valuation, why isn't it higher? The market values Cardinal moderately. Why? Canada oil is cyclical and there's no growth hype. Multiples are not high. EBITDA is solid, and that's good for income investors. But we don't have a valuation rocket case here. You're buying cash flow, not fantasy. Now let's move on to the risks. If the oil price falls below $55, the dividend comes under pressure. Regulatory changes are possible in Canada, but historically things have been stable. No diversification, 100% upstream. Small and mid caps are a bit more volatile, but we don't have a balance sheet disaster, no refinancing drama, and no high-risk deepwater project. So the risk is cyclical, not existential. So who is Cardinal Energy ideal for? Cardinal Energy is not a growth engine nor an ESG favorite, but rather a conservative, conventional Canadian oil producer with a solid dividend. It's suited for hard asset strategies, cyclical allocations, and those focused on cash flow, not for buy and forget dividend investors or low volatility seekers. With oil above $70, the whole thing is very attractive. With oil at $60, it's solid but a bit tighter. And below $55, you need to be cautious about the dividend here. What do you think? Stable dividend oil stock or too dependent on the cycle? Let me know in the comments. If you enjoyed the video, I'd appreciate a like right here. If you're not a subscriber yet and don't want to miss any more upstream episodes, I'd appreciate a like here. As always, this video is of course not investment advice, but simply my personal strategy. I wish you all successful investing and see you in the next video.